You know, in the movie The Rock with like Sean Connery and Nicolas Cage, the character Sean Connery plays, his name is Mason, has been imprisoned somewhere, but he used to be imprisoned in Alcatraz, right? And in the plot of the movie, has to help a Navy SEAL team get into the prison in order to save some hostages and make things blow up. To do this, he memorized, when he was in Alcatraz in order to escape from Alcatraz, he memorized the timing for what I think is a furnace, and he rolls on the ground into the furnace, but he has to time it so that he doesn't get burnt by these fires that are shooting through like randomly, but apparently not randomly. But anyway, he memorizes the timing, and he's in the furnace thing for a while, and then he comes out. He's waited just long enough for you to think, oh, I wonder if he burned up. And then he opens a door and he triumphantly says, "Welcome to the Rock." Well, besides the fact that this prison is just a tourist attraction at this point, it isn't holding 1,500 plus inmates. Not really sure the need of the full blown furnace to be operating. If he could have just walked out a door, why did he memorize the timing of the furnace? He walked out a door from inside the prison so that the guys outside the prison could get inside the prison. When he could have just done a little bit of old school open sesame, everything would have been fine. I don't know. But this isn't finding movie plot problems. This is covering HOAs with One Hot Mic. So I did a little traveling this week. Got to go up to Northern California, to the San Ramon area, which is east of the Bay, about halfway between San Jose and Oakland, if you're unfamiliar. Places like Pleasanton, Dublin, Walnut Creek, very nearby. Got to go up there for a board seminar with Associa, Northern California. And they brought in their managers and their board members for a day of learning, networking, and kind of gift giving, because we all give stuff out and we do a raffle. I had the privilege of speaking with, or alongside of, Colin McCarthy from Angus and Terry. He's an attorney specializing in the HOA world, as well as Peter Madsen, who is a board member, volunteer board member serving on his community board, and he's served on a number of community boards. And incidentally, Peter worked on our presentation, and then he also did a presentation alongside another attorney, Kang Lee, and they were talking about basically how to behave in the workplace and simple problems that community managers have with communicating with upset board members, upset homeowners. Kind of leads back to what we were talking about in episode 1 about just communicate, just be kind. It's that simple. But that's what Kang and Peter were talking about in that presentation. In ours, we were talking about, wait for it, insurance. And we were talking about some of the basics behind why we're here and what's going on, and simple kind of solutions, helpful tips, steps on how to work your way through this crazy thing we call insurance. Got a lot of good feedback, seemed pretty positive in our discussions. Lots of good questions from the audience. A couple of takeaway nuggets were, what is our premium going to do next year? Excuse me while I get my crystal ball out from the drawer. I don't know what the premiums are going to be next year. Reasonably, we can plan for an increase. The safest thing to say is about 25%. That's 2.5, not 6.7. And that's just being conservative. Obviously, each account's going to be different, and each account's going to get worked on in a different way. Lots of good interaction with board members and with community managers around the claims process and some of the things that are dealt with on a regular basis when it comes to a claim. So here's an example. Let's say an HOA, condominium association, has a property insurance policy with a $10,000 deductible, and they sustain the policy, or pardon me, the unit sustains damage of, in this example, I think it was like $250,000. It was a good fire. Well, good size, I should say. The only good fire is the one that's like cooking your food or warming your body. So $250,000 worth of repair costs. That's remediation, that's cleanup, that's dry out, that's reconstruction. All of those repair, all of that together. $250,000. And this community has a habit of paying the deductible on the HOA policy. And the question was, well, why do we have to pay the deductible? You don't. Unless your CC&R says you have to, and it's very rare. I've only seen it once. Unless your CC&R says you have to, you don't have to. It's a deductible. It's not an invoice. It's not a chargeback. It is an amount of money that is deductible from the payment of a claim. You paid premium to the insurance company, and you said, and in an event of a covered loss, we agree to your terms that you will deduct this amount of money from the payment of the claim. We didn't charge you for it, but we deducted it. The insurance company deducted it from the total loss. In $250,000 claim, that means you have $250,000. Oh, wait, we're going to deduct $10,000. Here's a $240,000 check. And then the association, because the association is the insured, the association gets to distribute those funds where they see fit. But this association was actually covering that additional cost, that exposure or expense, I should say, to the unit owner out of association funds. Not, in my mind, good. Because you're spending the membership's money to repair one unit or one owner's property, and the association has absolutely no responsibility for the maintenance, repair, replacement of a unit owner's property. So if I'm in the community, I pay assessments. Those assessments are intended to be operational cost or cover operational costs. And you're taking that money, you board of directors are taking that money and you're putting it towards someone else's home. That bugs me. That would bug me as a homeowner, as a unit owner in that community. If we were using my money to fix someone else's unit on something we don't have to provide coverage for or assist with anyway, because it's not our property. You see, the CC&R may say you have to insure things, but that doesn't change who's responsible for the repair, the maintenance of that piece of property. The unit owner is responsible for everything on the inside of the unit, for maintenance, repair, taking care of it, everything, right? The association has no cause, no insurable interest, if you will, in that inside property because the CC&R says that's the unit owner stuff. The question is, where is the unit owner going to get the money to make repairs to that property? And the answer is the unit owner can get insurance or insurance proceeds from a policy under which they are an insured. The unit owner pays assessments, assessments pay premium. The unit owner is an insured and has a right to the coverage afforded under that policy. In addition, most CC&Rs require Most insurance companies have language, insurance policies have language that, and all lenders will require the association policy to be primary with respect to a property damage claim. That means it comes first. The association's policy goes first. Whatever it covers, and then we look to the unit owner policy. We didn't used to do it that way. Now it's probably a decade ago. But today, because lenders know the association's policy is primary, and HOA carriers or unit owner carriers know the HOA policy is primary, that carrier needs to see what the association's policy is going to cover before they do anything. So the association's carrier is primary, comes first, covers the loss. The unit owner is responsible for the property. Absent of insurance, the unit owner would be paying $250,000. But because there's an insurance policy, the question becomes, where are they going to get the money? And they can get the money from the association's insurance policy because it was purchased for their benefit with their money. They just get it out of their HO6 condominium unit owner's policy. So, moral of the story, don't spend money that's not intended for that purpose. Don't pay that deductible. It's not a bill. It's just an amount of money that's left over. Here's my suggestion. Take the funds and pay the dry out, cleanup costs. The emergency services. Hard to draw the line between where the common area is, between the walls, between the ceilings and floors. Just use the money to pay it. It's part of the claim. Then use the funds to make repairs from the exterior of a building, HOA maintained space, property, to the interior surface of the drywall. So you've got the exterior of the building and the interior of the building, interior surface of the drywall. Everything between my palms is common area. We can agree to disagree on the definition of where the drywall stops. But fundamentally, everything between my palms, common area, association property to maintain. We just recovered funds from the association's policy. Let's use that to fix association property first. And then we can distribute the funds to the unit owner or the unit owner's contractor, depending on the size of the claim and the experience the board has. We can distribute those funds to for the owner's benefit. And then when we run out of money from the insurance company, guess how much is left? Oh, wait. Got it? Yeah, that's right. $10,000 because we deducted it in the first place. And now it's left to make repairs to the inside of the unit to property the unit owner is responsible for. So they use their own money to fix the rest of their home. And if this is either a larger loss or you have a higher deductible or there's property on the inside that isn't covered, for example, a bare walls policy versus a walls in or all-inclusive policy, if we're not covering any of those fixtures, the floor coverings, cabinets, countertops, bathroom fixtures, all that stuff, pick your unit up, flip it over, everything that stays stuck inside, if that's not covered under the HOA policy, unit owner gets to pay for that too, because that's their property. So that was one of the examples that I walked through with this group, with this audience. And needless to say, some of them were, wait, what? We can do that? Some were still on the fence of, well, I think it's right for us. Hey, there's nothing to say you have to or don't have to, unless the CC&R says so. There's nothing to say you can't provide that assistance to a homeowner, to a unit owner. But if your community is losing money, hemorrhaging, as it were, stop spending money you don't have to spend. Another common example or another common problem, issue, property loss that we see is vehicle damage to community property. Mike, somebody drove their car through our gate last night, and we know who it was because we have a camera and we saw their license plate, and we know it's unit under so and so, and so we talked to them, and they're saying the gate didn't work, blah blah blah. It's property damage to association property. Auto insurance carries, in the state of California, most states, there's a requirement for insurance, carries bodily injury liability and property damage liability. When you look at your auto insurance policy, that first line up there that says liability, it says 15, 30, and 10 if you're buying the minimums in California. That's $15,000 per person, $30,000 per occurrence, per crash, and $10,000 of liability insurance for property damage, for damage you might do to someone else's property, whether that's rear-ending a Cybertruck or running into an HOA building, wall, fence. That happens all the time. That's the money that is going to be used to pay for the damage to the association's property. So, okay, the call continues. Mike, but what do we do? Do we need to file a claim on our HOA or our association policy? You can, if you want to. What's really ideal is actually filing the claim on the auto insurance policy for the driver of the vehicle, because that's where the money's going to come from. The operator of the vehicle was negligent and therefore liable for the damage caused. Just like if you rear end that Cybertruck, you're responsible for the damage that was done because you rear ended him, aside from very, very, very few situations and circumstances. If you hit somebody from behind, you're liable. And you get that money from your auto insurance policy. I don't recommend state minimums. Look around when you're driving. Find a $10,000 car. There's very few. Even some of the jalopies that are rolling around there are more than $10,000, valued at more than $10,000. Certainly the lion's share, the large number percentage of cars on the road are in the 60, 70, $100,000 range when it comes to replacing them, rebuilding them. So don't buy $10,000 worth of property damage liability. You need to buy what's necessary to protect your exposure. And your exposure isn't what, when you see all these commercials, you'll only buy what you need to insure. You only pay what you need to buy. You know, there's that guy that wanders around getting himself in all kind of mischief. And he says, if you have the wrong kind of insurance, this may not be covered or something like that. Oh, every carrier writes the same stuff. Everybody. They write the same stuff. And you can buy whatever you want to buy. How much do you want to pay? That's premium. How strong is the carrier? How confident are you in the carrier? What coverage lines do you want? You don't have to buy it all. It's not like some magic thing that this one carrier has control of. We know how to, we can do this because we can build you a policy that is specific to you. I can build you a policy that's specific to you too. Everybody can. So pay attention to what you're buying. Why are you buying it? Why are you buying insurance? Well, I have to buy it in the state. Well, my lender forces me to do it. Yeah. Take your homeowner's insurance, for example. Your lender said, yes, you need to buy insurance because I want to make sure this property is replaced if it burns down. So ask yourself, why does the lender so focused on you having insurance? Because they know it's a good idea. They know it's a good deal. It is a great deal to spend 1% of the replacement cost, the rebuilding cost of your home, spend 1% in premium, while the insurance company takes on 100% of the exposure. That's insurance. That's a transfer of risk. You are choosing to pay premium. The insurance company is saying, okay, we will accept that risk. You can transfer it to us, and we will take care of the rest for these things. We call them perils, these events. But the lender knows it's a good idea because it's an inexpensive way to protect your property. You got $500,000, $1 million in the bank, and you want to self-insure, knock yourself out. But you probably don't. Condo association, $10 million, $20 million, $100 million project. You ain't got that in the bank, just sitting there waiting to be paid. But you can spend on a $100 million project $75,000, $100,000 in premium, and get full protection. Now let's just do the math. If I have a $100 million project and I spend $100,000 in premium, if I spend $1 million in premium, which is closer to that 1%, $100 million project, $1 million in premium, $1 million in annual premium, big place. It's going to take 100 years for me to pay $1 million a year in order to meet the exposure that the insurance carrier is taking on every year. 100 years of no claims. Not going to happen. One. Also, we're not going to be around to see it anyway. But that's why insurance is a good deal. Take on the big risk of fire and water loss, wind and hail, things that you can't really plan for. You can plan to replace your roof at a certain time and put the money aside on a regular basis in order to be ready for when the time comes that the roof needs to be replaced. That's what a reserve study is for. But you can't plan for a fire. I guess you can. And then you can light it yourself. And that's called arson. I wouldn't suggest that. You can't plan for a fire. You transfer that risk to an insurance company. That's insurance. Simple. That's what it is. We are heading out to Texas next week to talk to a management firm and their board members at a similar type of event. But this one we get to interact with the managers as far as presenting alongside them. So that'll be fun because they're going to be teaching on the reading of financial reports for a board of directors. And then I'm going to be talking about how we take that information and we put it into our process and determine limits. I warned you before, it's insurance. It's not really sexy, but it is information that you really need because it will help you understand the why behind why you buy insurance. Why does your association buy insurance? When you understand that, you can start to understand the concept, the process that insurance companies go through in order to provide you with that transfer opportunity. Watched a movie recently. Shocker, right? Watched a movie called Central Intelligence. It's from a few years back. Dwayne "The Rock" Johnson and Kevin Hart. Kevin Hart is he was the Mr. Popular superstar athlete, president, ASB president guy at his high school. The Rock plays a kid who was bullied at school. Bullying is a massively terrible thing. But in this movie, later in life, after Kevin Hart's character becomes an accountant and is basically stuck at a desk every day, all day. Nothing exciting about his football career after that. And The Rock has gone from a chubby, kind of awkward child to what you see The Rock, CIA agent, though still quite awkward in his characterization, I might say. They get together. They're talking about how their lives have gone, banter back and forth. But Kevin Hart's character kind of gets a little sullen. And he says, I don't feel like I'm the hero of my own story. And the Rock's character says, how can you not feel like the hero in your own story? Who else can be? And that sat with me. Because too often, we don't feel like forget about the hero in our story. There's sometimes I don't feel like I'm in the story at all. But I have to remember, it's my story. And I get to tell it. And I'm going to show you, I'm going to write it for you. I'm going to be the hero of this story. Give that to you. Go out there and be the hero in your own story. Come talk to us next time on Covering HOAs with One Hot Mic.